Right, everyone. In this video, which is going to be really important, it's about the currency markets and the Japanese yen. There was an interest rate decision today by the Bank of Japan, and I want to kind of talk about the interest rate difference between the United States, Japan, Europe, why the carry trade is the number one reason why the yen has been getting so weak over the past 2 years. And I want to explain the bond market driving the moves in the currency markets, because once you understand the carry trade and you understand how the bond market plays into the carry trade, it's going to change your mind and your perspective about how to trade the yen moving forward as the markets predict interest rate cuts by the US Central Bank and the European Central Bank, but more importantly, interest rate increases by the Japanese Central Bank. Because I just want to show you this. When the Federal Reserve started raising interest rates in 2022, you can see as interest rates was going up in March, look at the dollar yen exchange rate. We saw a massive depreciation in the yen as the interest rate on 10-year government bonds in the United States was going up. Okay, then whenever we had a period where the 10-year interest rate was going down in the US, the Japanese yen would immediately strengthen against the US dollar, okay? And then if the US government bonds interest rate started to rise again, as we saw here, well, then the dollar would straight away strengthen against the Japanese yen. And then if the 10-year government bond in the United States would decline again, then you would see the yen strengthen. And if the interest rates were going back higher again, then the dollar would strengthen again. So you can clearly see there's a big relationship between higher interest rates in the US, a stronger dollar against the yen, and as soon as the interest rates are going down in the US, the yen strengthens against the dollar. Now, why this is really, really important to understand is because the carry trade is a number one reason why currencies go up or down in value, okay? For a lot of people who don't understand macroeconomics and fundamentals, I'm literally showing you why exchange rates move, okay? So all you need to understand about a carry trade is this. The way investors make money when you're trading a currency pair is what they do is they want to try to find a country with low interest rates, and this is Japan at the moment. Interest rates are still at 0%. And they want to borrow money in Japan, call that country A, and they're borrowing money from Japan because interest rates are low, and then they want to exchange the yen into another country's currency like the United States where interest rates are high, okay? Because they want to then invest into US government bonds, which pay a lot more interest than Japanese government bonds, okay? So you can earn a difference from the interest rates. It's called the overnight carry, okay? So let's put this into perspective. Interest rates in the United States right now, okay, currently 5.5%. Interest rates in Japan are at 0%. If I borrow the Japanese yen to buy the US dollar, okay, interest rates in Japan are at 0, so I pay no interest on the yen that I borrow to fund the purchase of dollars, but I get paid 5.5% interest on the dollars that I purchase. So I can make a free 5.5% return on my money just by buying the dollar. And then I can take that money, as it says here, and invest it into the bond market. Hence why when you see the interest rate on government bonds in the US going up, investors are happy quickly to borrow the yen, finance the purchase of the dollar, make that 5.5% free interest on their money, but also catch a move in the exchange rate going up, maybe catch a move in the exchange rate as it goes up, maybe 30%. So imagine you're making 35% return on your money. Now think about big hedge funds, big investment banks, okay? Institutional players in the markets. That's a lot of money to be made. If you're managing $1 billion and you make 35% return, you just made 350 million. Hence why when the interest rates in the US were going up, the yen was the perfect funding currency because of low interest rates in Japan, okay? Now, what you need to understand, the dynamics are changing because the Bank of Japan today didn't raise interest rates, but they're setting the stage to potentially raise interest rates moving forward. Okay, now this is the key, because if I show you over here, I was just reading this right here. The gap between Japan and the US bond yields, so the interest rate and government bonds, just as I was showing you, remains wide in the dollar's favor. Hence why the dollar's so high against the Japanese yen right now. But look what it says. Anticipation of lower interest rates in the US may be offering the Japanese yen support. So just understand how this plays out, okay? If you're a trader and you've already made a huge return on your money, let's say you've caught the whole move, you're at 40% on your money, right? You're getting all this interest, all this free interest, plus you've made 38% on the currency move. The moment the interest rate in the US goes down, like here on the 10-year government bond, this is why the yen strengthens so dramatically quickly against the dollar, because for investors to make a profit off this carry trade, you need to make sure that that 5.5% difference in interest rates that you're getting paid to your investment account because of the difference in interest rates between the two countries, if the exchange rate drops by 16% dramatically, well, then the overnight carry doesn't work because the currency pairs drop by 16%. Yes, you may be making 5.5% interest from the difference in interest rates, but as soon as the currency pair goes down more than the interest you're getting paid, you don't make any money. You lose money because then you're an investor selling the dollar back into the yen and you've lost out on your return. So the moment you see this drop in the bond yields based on interest rate cut expectations in the US, this is why you get sharp moves in the dollar yen. And then you saw another sharp move here, 8%, soon as you got a decline in the bond yield over here. Okay, so what we need to understand right now is this. In Japan, they've had a very, very low inflation problem for like 30 years, since the 1990s. They've had a deflation problem. The Japanese economy crashed, the stock market crashed, never returned until literally last year. And basically, the Bank of Japan decided to cut interest rates to record lows of 0%, trying to get inflation to get back to 2%, okay? Why did they do that? Well, just think about it. You cut interest rates low, everyone has low interest rates on their mortgages, credit cards, car loans, student debt payments, etc. They can borrow money cheaply, they'll spend money, the demand for goods and services goes up, prices rise, they can get inflation going up, and also the economy is growing because people are spending. However, Japan's had low growth for a very, very, very long time. Now, what the Bank of Japan did to try to counteract this is they decided to purchase 10-year government bonds, okay? So this bond you see in the US, when this one goes higher, mortgage payments in the US go up, credit card payments in the US go up, car loan payments in the US go up, student debt payments go up in the US, personal loan payments, business loans, everyone's monthly interest payments go up because they're actually pegged above the 10-year treasury bond. Okay, that's why this bond is called the benchmark. It literally drives everything. This is the most liquid, most highly traded asset in the world, the 10-year government bond, okay? So the Bank of Japan, which wanted to keep their interest rates very low, what they've done since that crash in the 1980s, in the late 1980s, look, Japan's interest rate right now is only 0.92%. The US right now, 4.21%, so a big difference, okay? What the Japanese central bank has done is they've been purchasing government bonds on purpose since that crash to keep prices of bonds high and keep the interest rate, known as yields, low. Now, the reason this is, if you keep bond prices high, interest rates stay low, is because there's an inverse correlation. So I'll explain it to you if you don't understand bonds. It's really easy. If you buy a $10,000 bond, right? If I borrow money to someone, I give them $10,000 and they promise to pay me 2% interest, well, I'm going to make $200 a year, right? On that bond. If then the bond's price rises to $12,000 after, my $200 as a percentage of 12,000 is now 1.66%. So you see how if the price of the bond goes up, the interest payment, which is a fixed amount of interest, goes down, okay? So the price of bonds and the interest rate is inversely correlated. So what the Bank of Japan has been doing, they've been buying government bonds, especially the 10-year, on purpose for a very long time to keep the price of bonds high and keep the interest rate in government bonds low, so they can basically allow borrowing to be cheap. Mortgages, credit cards, car loans, student debt payments, right? So interest rates in Japan have been low for a very, very, very long time. The Bank of Japan's interest rate right now is 0%. 10-year government bonds are only 1%. Okay, so they're very, very low, which means Japanese investors don't want to buy government bonds in Japan because they're paying no interest. So what do? Japanese investors sell their yen, buy dollars, buy US government bonds that pay 5.5% interest, and they get an appreciation on the dollar's value going up 20-30%. So when they decide to cash in their money, they've made a big, big profit. Okay. Now remember what I said to you. When investors sell the yen to buy the dollar, As long as the yen stays weak and the dollar doesn't weaken against the yen by more than the interest they're getting paid, they're making money. This is called the overnight carry trade. That's why as the interest rates are going up, there's more money flooding into the trade. But as soon as the interest rates go down, the trade unwinds, okay? So why is this important? This is very important is because the Bank of Japan has kept interest rates low for a very long time. They've been doing this thing called yield curve control, where they're buying the 10-year government bonds on purpose to keep the price high, okay? Like I showed you here, causing the price to go from 10,000 to 12,000, keeping that interest rate low, but they're setting the stage right now for interest rate increases in Japan. Over here, we have this spreadsheet that we use to know where interest rates are going. And notice, the markets are predicting rate cuts in the United States. So look, rates are going to go from 5.5%. By next year, they're going to go down to 4.5%. So that interest rate difference is going to be going down. It's not going to be paying as much interest anymore. And if you look at the Bank of Japan, the markets are betting that the Bank of Japan is going to be raising interest rates. Okay? So what the Bank of Japan did today, they didn't give details on when they're going to cut the amount of bonds they're buying. And the reason they're going to start cutting bonds, how much bonds they're buying, because they're setting the stage for raising interest rates for the first time, well, second time in over 30 years. They only raise it this year, but they're going to start raising it more and more because inflation finally has come to 2%. So they don't need to keep interest rates so low anymore. So what does that mean? Remember what I said to you guys about the bond market. If the Bank of Japan is hinting they're going to stop buying government bonds, well then what happens? Remember, if they reduce buying bonds, then there's a decreased demand for bonds, causing the prices of bonds to drop. Remember, they've artificially pushed up the price to 12,000, as I gave you this example, okay, making the interest rate go to 1.66% from 2% as an example. But what if the bond price falls to $7,000 if they stop buying bonds? Well, that interest rate of 1.66% now goes up to 2.85%. What's going to happen if Japanese interest rates go up? Investors obviously are going to want to cash in quickly on their dollar yen trades because investors understand that the interest rate difference, that overnight carry trade I was showing you over here, is no longer going to be paying as much profit. If interest rates in the US go down to 4.5%, so notice over here, sorry guys, notice over here, sorry, I don't know what happened there. Notice over here how if you're selling the yen to buy the dollar, if you're taking a one lot trade in the currency markets, you could be making $15 a day, right? But think of a big fund trading big lot sizes, yeah? Big funds could be making hundreds of thousands a day if you're trading billions, right? Soon as these interest rates go down, notice, let's say you're making 150 grand a day on the interest rate difference. Soon as that starts going down, guys, look how much the difference goes down. Let's say it goes down to 130 grand a day, okay? But what if the Bank of Japan starts raising rates at the same time? Well, that interest rate difference goes down even more, down to only 100K a day. Now, yes, you're making money on that trade, the interest you're getting paid over, remember, 365 days. But remember what I said, if the exchange rate tumbles 16%, who cares if you're going to be fucking making that much money? Because the losses you're going to make on the exchange rate are going to counteract how much you're making. So investors obviously would rather protect the trade whilst at these high levels. Let's say you're in that trade from early and you've made all this money. You don't want to go from having a 37% return to only having a 12% return, do you? No. So as the Bank of Japan stops buying bonds, causing the interest rates in Japan to rise, Japanese investors who have sold the yen to buy the dollar to earn that difference in interest rates in the US over Japan, soon as the interest rates in Japan go higher, they know this currency pair is going to drop. Now, who cares if you're making 5% interest in the United States if the currency pair automatically then tumbles by 15%? You're losing money now. So this is why when the markets are predicting these rate cuts in the United States followed by rate increases in Japan, you're going to see the carry trade unwind, okay? Because investors are going to be selling the dollar and going back into the yen quickly to lock in their profits before the exchange rate drops dramatically and they lose all the profits they've made, okay? So what you're seeing is this. At this moment in time, obviously the dollar is very high against the yen, but the markets are pricing in rate cuts and the bond yields are turning over. Notice now, right? As the bond yields are turning over, the dollar's no longer going up against the yen. And if the market start pricing these rate cuts like they did here or they did here, the dollar is likely to have these kind of sharp moves lower because investors are getting out of the trade. Okay, so we could see now with lower interest rates in the US, dollar yen has peaked and we're likely to see the currency pair come lower. Euro JPY has peaked, can't go any higher because European bonds are no longer going any higher. Notice something, guys. Have you seen that the euro yen exchange rate has peaked because the bond yields in Europe are no longer going higher? And in Europe, look, guys, the markets currently are predicting steeper rate cuts in Europe than they are in the United States. Look at the rate cuts in Europe expectations. The markets predict the ECB to cut rates aggressively. Okay, so now you're starting to see what's likely to happen. Investors are going to sell their euros, sell their dollars, repatriate their money back into the yen quickly to take their profits at a high level before the carry trade unwinds. That's a perfect example as to why this headline is talking about the carry trade. It's the most important thing in the currency markets. Interest rates drive currencies, and it's all being driven by the bond market because investors, just to remind you, they are borrowing money in country A, like Japan, and investing in currency B, like the United States, where interest rates are high. But the moment the interest rates go down, this carry trade doesn't work anymore because the exchange rate will go against the investor so quickly they need to cash in on their trades. That's where you get sharp moves lower. Okay, I do teach this on my Forex course to go deep into macroeconomics because you need to understand this, guys. If you don't know this and you're trying to trade, you're basically trading blind. Okay, leave a comment in the video and let me know. Did you even understand carry trade? Did you understand the bond market? Did you really understand why bonds are literally driving currencies consistently in the markets? Now you know. Now you can trade more smartly. Okay, not make amateur mistakes. Try and trade technical analysis. You don't know what the fuck's going on. That's what most people do, is amateur trading. Okay, so hope that makes sense, guys, man. Let's catch this yen move. Obviously, I've sold euro yen on my members. We're in a profit right now. You can see that we jumped in at this level here. We're already in a profit. I'm going to hold this trade all the way down as the ECB cuts rates. Make big profits on the trade. All right, guys. Hopefully you make money too.